We're living through a really strange economic time. Doesn't it feel like your savings are just shrinking? Like they're losing value every single day? And maybe the system's a little bit rigged? Well, today we're going to pull back the curtain and figure out exactly why that is. We're going to dive deep into the late stages of this massive debt cycle, get to the bottom of why governments just can't seem to stop printing money, and we'll ask the big question: is something new like Bitcoin actually the answer?
And this quote from the legendary investor Ray Dalio, man, it just cuts right to the heart of the matter. He says, when governments print a ton of money, they're cheapening it. And that's not some abstract economic theory, folks. He's basically describing a tax, a hidden tax on your wealth, paid through the debasement of your currency. That right there, that's the core problem we're unpacking today. That slow, steady, relentless erosion of the money you worked so hard to save.
All right, so here's how we're going to break this down. First up, we'll look at what we're calling the perpetual debt machine. Then we'll see why that's leading to a flight to scarcity. After that, we'll tackle Bitcoin's dual nature. Is it a hedge or a hazard? And finally, we'll get practical and talk about how to think about sizing the asymmetric bet.
Okay, first up, the perpetual debt machine. To really get how we ended up here, we've got to zoom out and look at the big picture. And that's where Ray Dalio's framework on these long-term debt cycles is so powerful. It's really the key to understanding this perpetual debt machine that seems to be driving everything today.
So here's Dalio's big idea in a nutshell. It's called the long-term debt cycle. Think of it as a pattern that repeats roughly every 50 to 75 years. It starts with a boom, everything's great, but then debt just keeps growing faster than income. Eventually, you hit a wall. The debt becomes so massive, it's literally impossible to pay back. And at that breaking point, governments have two really terrible choices. They can either default, which means catastrophic collapse, or they can print a ton of money to devalue the debt away. And guess what? History shows they almost always choose to print.
And this chart here really shows you the logical progression of money through these cycles. It's almost inevitable. You start with what's called type 1. That's hard money, like gold. It's super trustworthy, but it's also really rigid. So to get more flexibility for growth, countries move to type 2, which is paper money backed by gold. But when a real debt crisis hits and they need the ultimate flexibility, the ability to just print, they have to cut that final tie. They move to type 3, fiat money. And what's that backed by? Nothing but a government's promise. And that, right there, is exactly where the entire global financial system is today.
And you could see these exact moments playing out with the US dollar. Back in 1933, to fight the Great Depression, Roosevelt broke the link to gold. Fast forward to 1971, Nixon cuts the final tie, and bam, we're in our modern fiat system. Then, 2008 happens, the financial crisis, and then 2020, the pandemic. In both cases, the money printers were just unleashed on a scale nobody had ever seen before. Every single one of these steps was a reaction to the same problem, a mountain of debt that was otherwise impossible to pay off.
So the really crucial thing to get here is that this has become a totally predictable playbook. Step 1, central banks lower interest rates to make borrowing super easy and get the economy going. But what happens when rates hit zero and that tool is basically used up? Well, they move to step 2, quantitative easing. It's a fancy term, but all it really means is they create new money out of thin air to buy government debt. And the end result is always step 3. The value of your money goes down. It erodes the real value of the debt, but unfortunately, it takes your savings down with it.
So think about it. If you've just seen that the cash in your bank account is essentially designed to lose value over time, what do? Where do you go? Well, you start looking for something that can't just be printed into oblivion. And that brings us perfectly to our second section, the flight to scarcity.
And this right here is the fundamental problem for every single saver today. The very assets we were all taught were safe, cash in the bank, government bonds, are now almost guaranteed to lose you purchasing power. When you factor in inflation, your real return is often negative. I mean, think about that. You are literally paying for the privilege of lending your government money while that same money just evaporates in value. It's crazy.
And this, of course, is where a totally new kind of technology enters the picture. Bitcoin was literally designed with a solution to this exact problem in mind. It's called algorithmic scarcity. See, unlike the dollar or the euro, its total supply isn't decided by a group of people sitting in a meeting room. Nope, it's governed by pure mathematics. It's fixed in the code. There will only ever be 21 million Bitcoin. Period. No one, no government, no central bank can change that. And look, this isn't just some niche idea for tech enthusiasts anymore. It's a genuine global phenomenon. You've got people in Nigeria using it as an escape hatch from their own currency's massive inflation. You have investors in India turning to it to protect their wealth. And yeah, more and more, you have everyday savers in Western countries looking at it and thinking, hey, maybe this is how I protect my future from this constant slow drip currency debasement.
Okay, but this brings us to what is probably the most critical and hotly debated part of this entire story. We're talking about Bitcoin's dual nature. It was built to be a hedge, right? A defense against the problems of the traditional system. But is it actually a reliable safe haven? Or is it just another high-stakes, super risky asset?
So let's just ask the question straight up. Is Bitcoin a true safe haven? I mean, we hear that term digital gold thrown around all the time. But does it actually do the job? Does it protect you when the markets really start to go haywire?
Now, before we can answer that, we need to be crystal clear on what a safe haven actually is. It's not just something that goes up in value over a long time. A true safe haven is an asset that holds its value or even increases in value specifically when everything else is crashing and burning. That is its one and only job.
And right here, you see the two sides of this coin, the heart of the whole conflict. On one hand, you have the theory, what we call digital gold. It's scarce, it's decentralized, it's outside of government control. It sounds like the perfect store of value. But then you look at the reality. So far, it's behaved more like a volatile risk asset. During the COVID market crash in 2020, it didn't save you. It fell right in lockstep with the S&P 500. And that's because it's super sensitive to interest rates. It loves it when central banks are printing cheap money, and it gets absolutely crushed when they tighten the financial conditions.
And this quote from some recent academic research just sums up the problem perfectly. It says that rather than acting as a safe haven, Bitcoin might actually increase your portfolio risk, right when you're craving that protection the most. So instead of being a life rafter in the storm, it's historically been like tying an anchor to your portfolio.
All right, so where does that leave us? Bitcoin is clearly volatile, it's clearly risky, but it also seems perfectly designed to protect against that long-term money printing we talked about. So what do you do with that contradiction? Well, in our final section, we're going to look at a strategic framework for thinking about this. It's all about sizing the asymmetric bet.
Look, the solution here isn't a simple yes or no. You can't just dismiss Bitcoin out of hand, but you also can't go all in. That would be crazy, given its volatility. The real key is to treat it as an asymmetric, high-volatility hedge. You have to reframe it. It's not about digital gold protecting you in a crash. It's about making a calculated, high-upside bet.
So what does this asymmetric bet framework actually look like? Well, first off, modest position sizing. We're talking a small allocation, an amount you could stomach watching fall, say, 80%, without totally freaking out. Because trust me, that can and does happen. Second, you need a long time horizon. This is a bet on long-term monetary disorder, not a get-rich-quick scheme. Third, you have to expect deep cyclical drawdowns. Those massive price drops, they're not a bug, they're a feature of this asset. And finally, you have to treat it as what it is, a hedge. A bet that our trust in traditional fiat currencies is only going to continue to erode. And of course, this is not a risk-free bet, not even close. When you compare it to something like gold, the risks are totally different. With gold, you're worried about old world problems, right? Like opportunity cost or central banks selling off their stockpiles. With Bitcoin, the risks are straight out of the 21st century. We're talking about regulatory crackdowns, technical vulnerabilities like a 51% attack, or just black swan events like a major exchange going bankrupt.
And that really brings us to the final, lingering question we should all be asking ourselves. As central banks keep going down this path, basically trapped in a cycle of printing more money to deal with debts they can't pay, maybe we need to flip the script on risk. Maybe the question isn't, is it too risky to own a scarce asset anymore? Maybe the real question is, in a world of perpetual debasement, what is the true cost of not holding one?